Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and kicking off this week's episode with the usual macro debrief. So a lot to digest this week on the macro front. Let's start with consumer sentiment. CB consumer confidence came in at 97.2, higher than the consensus of 95.9 and higher from the previous number of 95.2. If we look at Michigan consumer sentiment, that came in at 61.7, slightly lower than the expected 61.8, but more or less in line, and higher from the previous reading of 60.7. So if we compare it to previous months, obviously consumer sentiment, consumer confidence has recovered, right? The average consumer is starting to feel a lot more stable, confident, I guess, hopeful for the future, but that might change in a second as we move on to the labor market, as we move on to understanding, I guess, more about what the future of the rates look like, right? So looking at the labor market, JOLTS for June came in lower than what was expected, 7.437 million versus the 7.51 million. This is lower from the previous number of 7.712 million, right? So this has been trending downwards for a while. We know that the labor market has been slowly and gradually weakening. ADP non-farm employment came in at 104,000 versus 77,000 consensus. This was for July. The big topic, I think, for this week, and a lot of what spooked investors on Friday was non-farm payroll. Right, this came in at 73,000 versus the expected 106,000. So it's a pretty drastic difference in terms of what the expectation was, and significantly lower, right? So we know that the labor market is weakening, and this data just confirms that. What is more ridiculous, though, is the subsequent downward revisions of May and June numbers for non-farm payroll. May was down from 144,000 to 19,000, and June was down from 147,000 to 13,000. I understand there being some discrepancy, and revisions for macro data like this are somewhat expected, but this magnitude is rather ridiculous. I mean, the two numbers paint a completely different picture of the labor market and what it looks like, and this is extremely contrary to what investors and analysts have believed based on the prior data, right? So no wonder the market gets spooked out, because when you go from 144,000 to 19,000, that's day and night difference. So I think these numbers coming in, these revisions coming in, change the entire narrative of what rate cuts may look like, and perhaps serve as a much more compelling need going forward. If we look at the unemployment rate, though, 4.2%, in line with expectations. It's not drastically different, right? It's not changing too much. It's been around that 4.2% for a couple months. Continuing jobless claims and initial jobless claims both coming in lower than expected, similar to last week's numbers. So a bit of a mixed picture here up until we look at that non-farm payroll number. The unemployment rate itself doesn't seem to be too worrying, but the revisions, as I mentioned, definitely spooked the market Friday. All major indexes were down rather bad. So I think we have to be more vigilant on the labor market going forward, and maybe the Fed's dialogue will change subsequently as well. Looking at economic growth and inflationary factors, right? GDP came in at 3% for Q2 versus consensus of 2.5%. This is a solid bounce back from negative 0.5%. But let's put this into context, right? The negative 0.5% would have primarily been due to net exports being lower. Many companies would have front-loaded imports due to tariff pressures. So while this number is encouraging, and while this whole comeback is encouraging, perhaps good to take it with a bit of pinch of salt until we see the numbers for the next two quarters. But 3% for Q2 versus a consensus of 2.5 is solid nonetheless. And obviously the Fed interest rate, that was held steady at 4.5%. I did touch on this a bit earlier, but based on the data, holding rates steady would have made sense. And Powell also issued a cautious approach to cutting, and At that point, maybe a September cut, traders were not pricing it in as likely as some may have thought. But these revisions have changed that entire narrative. I still do believe that given the data, Powell has done a good job here to bring the economy back from inflation. But and while I understand that there is a very real risk that inflation will return, and I understand this measured approach, the Fed's mandate is also to keep the labor market in check and to ensure that unemployment does not spike. So how they manage that is going to be interesting. And I think, obviously those revisions and Friday changes that narrative, at least for September, pretty strongly. Looking at inflation, we saw PCE come in slightly higher than expected. Same with core PCE, right? 2.6 was PCE versus consensus of 2.5. Core PCE came in at 2.8 versus consensus of 2.7. This reinforces, I guess, maybe that tariff-driven inflation perhaps creeping in, right? We're at the start of this process, and maybe the rates being held was a good idea. I guess all in all, the macro picture doesn't paint a dreaded picture yet, right? We don't need to panic about drastic inflation or frantically cut rates in either measure, but the labor market updates do change the dynamic, right? And it definitely, as I said, brings back into play a rate cut in September. Looking at just the tariff and trade deals, we saw EU and South Korea deals come through. Canada and India have had their tariffs raised to 35 and 25% respectively. A Mexico deal is extended by 90 days. And looking at Brazil, Trump has hit them with a supposed 50% tariff. And, the notable thing from this impact to Brazil was on the price of coffee, right? And that is something that the first thing I thought about is it would be interesting to see how that is affected. Coffee is not part of the exemption list, and with Brazil being the largest exporter of Arabica coffee beans, which are majority of the coffee beans in the world, I wonder whether the US companies will continue to source from Brazil and pass through prices to consumers, or whether they're going to be shopping elsewhere and buying those Arabica beans elsewhere. Currently about 30% of the US coffee beans come from Brazil, so it is a sizable amount. The way coffee beans are grown has a lot to do with weather, climate, humidity. So I think not every region can grow coffee. So Brazil remains a very, very key part. And I do suspect that, your regular Starbucks cup of coffee is probably going to get a little more expensive in the months to come. Now, moving away from macro onto earnings, there were, I guess, two themes that I wanted to touch on today. Obviously, the big news of the week was big tech, right? So I'll get onto that later, but I wanted to touch on the payment space a bit. This is primarily due to, obviously, Circle's IPO, the rise of stablecoins, the Genius Act, the Clarity Act. I wanted to somewhat understand what that landscape looks like and how some of these legacy players in the payment space are dealing with it, pivoting their business, or even trying to grow with the disruption that's occurring in the payment space, right? So I wanted to start with PayPal. This has been a stock that, well, I should say this has been a company that has been, I would say, a legacy player in the digital fintech and payment space, right? They reported strong overall results, a beat on both the top and bottom line, but the stock was down about 8% after earnings. Earnings per share came in at $1.40 adjusted versus the expected $1.30. Revenue came in at $8.29 billion versus an expected $8.08 billion. Sales increased 5% year over year from $7.89 billion. Transaction margin dollars rose 7% to $3.84 billion, but growth in that metric slowed sequentially. It was down from 8% in the first quarter, and when excluding a one-time benefit that boosted results earlier this year. Branded checkout volumes also slowed to 5% compared with 6% in the first quarter when adjusted for leap day. Expenses rose and cash flow fell. So a mixed bag of results here, right? Total operating expenses were $6.78 billion in the quarter versus $6.26 billion in Q1. little higher on that end. Adjusted free cash flow in the quarter was 656 million, which is roughly a third of what the street was expecting to see. It was a drop from 1.4 billion in the first quarter. Total payment volume, which is essentially an indication of how digital payments are faring in the broader economy, beat estimates, coming in at 443.6 billion compared with the 433.6 billion that analysts had projected. Number of active accounts rose 2% to 438 million versus expectations of 437.8 million. As I mentioned, a mixed bag of results, some good, some bad. It's somewhat understandable why the street reacted negatively to earnings, though, especially when you see their adjusted free cash flow, when you see their rise in expenses, and at a time where a company like PayPal are facing competition from the likes of Apple Pay, Google Pay, other agile fintech companies, and stablecoins now as well, it makes sense why investors may be spooked. But I think we need to remember that PayPal holds a 45% market share, right? And they remain a dominant player in digital payments in that entire landscape. Their ability to leverage their global reach, their cross-border transaction capabilities, and just a wide customer base in order to defend that position and capture new opportunities is still very, very strong. They are investing in digital wallet upgrades, AI-driven personalization, product innovation is, something that they expect to revive user engagement. They hope to, obviously, using a lot of these investments, drive operational efficiency, perhaps even create new revenue streams, and this would potentially drive a turnaround in both performance and sentiment. To be honest, this stock has been quite stagnant for the last few years. It's really hovered around similar ranges. I do think there's a growth story here, right? Especially with the rise of stablecoins. PayPal have their own stablecoin pegged to the USD. They have growing partnerships, and just how PayPal are positioned within the entire payments ecosystem, I think they're one of the players that can actually leverage their technology, efficiency, and investments to grow their business into wider revenue streams and deliver shareholders strong returns going forward. Moving on to Visa, another legacy payment player. One of the more traditional payment players, I would say. Net revenue was up 14% year over year. EPS was up 23% year over year. Global payments volume was up 8% year over year in constant dollars. Cross-border volume was up 11% year over year. And this excludes intra-Europe. Processed transactions grew 10% year over year. Commercial payments volume was up 7%. Year over year, Visa Direct transactions grew 25%. Value-added services revenue was up 26%. Now, operating expenses grew 13%, and they continue to buy back stock. Approximately 4.8 billion in stock was repurchased. Visa was down about 5% for the week. Forward guidance, if we look on a forward-looking basis, was maintained. Adjusted net revenue growth was expected in the high single digits to low double digits, and full year fiscal year 25 net revenue and EPS growth was projected to be stronger than what was previously anticipated. Q4 adjusted EPS growth is expected to come in the high single digits. So it's a little bit of a mixed bag in terms of why the stock was down 5%. I do think a lot of this comes from sentiment around losing to some of the stablecoin companies and the newer age fintechs. But the way I look at it is, stablecoins for Visa are a growth opportunity, right? Especially in emerging markets and cross-border money movement. Visa is investing in infrastructure, settlement capabilities, and advisory services to help support stablecoin transactions, and they themselves expect this to accelerate digital payments penetration across the globe, right? They're embedding the stablecoin functionality rather than posing as competitors here. And, contrary to popular belief, and maybe contrary to the way the market views it, I actually think companies like Visa and MasterCard, which I'll get to in a bit, can actually benefit from the stablecoin movement, right? I think of these guys not as direct competitors, but more as custodians of the payment infrastructure and an integral part to drive adoption and an increase in adoption with stablecoins, right? I actually believe Visa and MasterCard are going to be key players in driving that. There may be, sure, some revenue cannibalism, but I do think this may open up new opportunities for them, especially as they transition into a new phase. So I would, overall say I'm quite excited by these two companies at the moment. And quickly just touching on MasterCard's earnings as well, much like Visa, pretty decent quarter. They reported a strong Q2 for 2025. Net revenue was up 16%, adjusted net income up 12% year over year on a non-GAAP currency-neutral basis. Operating income rose 17%, and EPS came in at $4.15. Key growth drivers here included obviously a healthy consumer and business spending. They continue to expand partnerships with American Airlines, Walmart, Uber, PayPal, Afterpay. They had strong performance from value-added services, which was a 22% increase in net revenue. And they continued to focus on differentiated solutions in cybersecurity and customer engagement. Their cross-border volume increased 15% globally, with card-present transactions driven by 75% contactless penetration. So overall, global gross dollar volume grew at 9%, with 6% growth in the US and 10% outside the US. So, this increase of cross-border volume kind of adds to that point of where I feel Visa and MasterCard can really leverage stablecoins. They don't have a dying cross-border volume business, right? They're not being replaced at the moment. And I think if they're ahead of the curve and they're fast to react and agile, they'll be positioned very, very nicely to benefit off of this change in the payments landscape. If you look at the full year 2025 outlook, that was tightened a bit. Now MasterCard are expecting net revenues to grow at high end of the low teens range. This excludes acquisitions. And Q3 net revenue growth is expected at the high end of a low double digits range. So reaction to their earnings, I would say, was a little more positive than Visa, but for the week, the company also ended about 1.3% down. All these companies, I would say PayPal, Visa, and MasterCard, and the payment space obviously is quite hot at the moment, so I did want to touch on it. I do believe that these names, specifically these three, have received somewhat less love than the others in the space, and they remain, in my opinion, imperative and key elements of the digital and overall payment ecosystem. So definitely companies that I would be interested in, I would be looking out for, and potentially even buying. Moving on to big tech, I guess what many investors would consider the main event for the week, right? Let's start with Microsoft, another company that was temporarily welcomed into the $4 trillion club alongside NVIDIA. Microsoft, solid, strong earnings, a beat on both the top and bottom line. Stock was up 9% after hours post-earnings, and then closed roughly 4 to 5% up the next trading day. So looking at their results, EPS came in at $3.65 a share versus the expected $3.37. Revenue was higher than expected, $76.44 billion versus the expected $73.81 billion, up 18%, which marked the fastest growth in over 3 years for the company. The standout from their quarter was by far Azure. Fiscal Q4 revenue for Azure grew 39%. Analysts were expecting growth of about 34 to 35. In all of fiscal 25, Azure and other cloud services grew 34% from the prior year, which is up to north of $75 billion for the year. Productivity and business segment, which includes their Office product suite and LinkedIn, also topped estimates, coming in at $33.11 billion. Consensus was $32.12 billion. And I would say just Microsoft is one of the companies that seems to be successfully monetizing AI fastest. They mentioned that the adoption of the Microsoft 365 Copilot led to higher revenues per user, with 100 million monthly active users now for Copilot. On their more personal computing unit, this encompasses their Windows, search advertising, devices, and video games. That totaled $13.45 billion. The number was up 9%, higher than Street Account's $12.68 billion consensus. And guidance was solid too, increasing the top line forecast and also forecasting aggressive Azure growth at 37%. Post Alphabet earnings, I would say for big tech in general, everyone's curious about CapEx and infrastructure spend and who's going to be spending what and how fast people are going to be accelerating CapEx. Amy Hood, who is Microsoft's finance chief, said that for their fiscal Q1, which is their next quarter, she sees CapEx spend coming in above $30 billion, which works out to be 50%, more than a 50% growth, I should say, annually. This is higher than what some analysts were expecting at $24.23 billion. Now, the company continues to face data center infrastructure shortages, right? It's continuing to ramp up capacity for running AI models. And, overall, this is crazy. I've just never seen anything like it. The demand for infrastructure build-outs and I guess for AI is just insatiable, right? Especially from these big tech companies. And now we're actually seeing Microsoft successfully start to monetize aspects of their AI spend in their productivity tools. So, overall, a very strong quarter. The company is obviously incredibly highly valued, and it's done incredibly well. So it's just one of those names where you have to look and be impressed at their quarter and think that for a company this large to be growing at this rate, it's just incredible. And moving on to Meta, earnings from Meta were arguably the best of big tech season, nothing short of impressive. The company they have had a great comeback story since the aggressive decline in 2022. It's up over 650% since and just continues to impress. The stock closed up 11% the day after earnings as Meta reported extremely strong earnings that beat both the top and bottom line. Total revenue was up 22% year over year. Operating income margin was 43% and net income was up 36% year over year. Daily active users across all their apps exceeded 3.4 billion and engagement continues to increase. This is driven by AI enhanced recommendations. Now, when you think of how big the world is, almost half the world use Meta products on the daily. That's incredible. I mean, that's just, putting that into perspective, it's a massive achievement for a company to be so widely adopted. AI-driven improvements led to a 5% increase in ad conversions on Instagram and 3% on Facebook. Similar gains in ad relevance, ad creative, and time spent. Nearly 2 million advertisers are using Gen AI creative tools now. Their third quarter 2025 revenue is guided to be between 47.5 and 50.5 billion. Total expenses for full year 2025 are expected to come in at 114 to 118 billion, which is up about 20 to 24%. CapEx, they narrowed the bottom end of their CapEx spend, which is narrowed down to 66 to 72 billion, right? Further expense and CapEx acceleration is actually forecasted for 2026, which is primarily driven by infrastructure and AI talent investments. Now, I think one question a lot of investors would have is around the spend for talent, right? We see Zuck shelling out insane numbers to assemble his super intelligence team. We've seen the acquisition of Scale AI. And this kind of seems like the moment, where he goes all in again. Just like the metaverse, except maybe this time it pays off. And Meta are clearly making enough money to help cover these costs. The core business, which is ad revenue, continues to grow at an incredibly solid rate, which is why maybe investors aren't alarmed too broadly. Overall, I'd say just a solid quarter for Meta and Zuck. Great to see a company being able to so successfully monetize AI in their ad revenue and to be so widely adopted. It's just impressive. Now, moving on to what I would call the two laggers of big tech, the two laggers of FANG, Apple and Amazon. So starting with Apple, Yes, they reported earnings that beat both top and bottom line estimates. I don't think the expectations were too high, though, coming into this one, right? EPS was higher than expected at $1.57 versus $1.43. Revenue came in at $94.04 billion versus an expected $89.53 billion, so that's a pretty big beat, 10% year-over-year growth. And obviously, if you look at the breakdown of their products, iPhone and Mac revenue both beat consensus estimates. iPad revenue came in below consensus estimates. Other products revenue also came in below consensus estimates, and services beat what analysts had expected. Gross margin came in higher than expected. But, I think with Apple, the big questions or concerns, especially that I had, were around two things, right? Tariff implications and how they're going to deal with that, and AI. So, addressing number one, on the tariff front, the company incurred $800 million in costs for the June quarter, which was lower than estimated. Estimated number is $900 million. And assuming no change for the quarter, Tim Cook expects $1.1 billion in costs. Encouraging that it was lower than what was estimated. But it's also worth noting that Cook himself mentioned about 1% of the growth out of that 10% can be attributed to customers buying more products to get ahead of tariffs. So, right, this demand that we saw may not be sticky. It may not be sustainable. It may just be a one-time thing to front-run tariffs. Now, moving on to the other concern that I have, being AI. Apple has lagged the big tech peers in both adoption and utilization of AI. There's no question about that. And I think we're at a point where it's pivotal for Apple to accelerate this. Otherwise, they are going to start losing share to products that do have strong AI embedded. I mean, we're shifting into a new generation of handheld devices and products and machinery that needs to be AI savvy, right? We need, because if efficiency is the name of the game, these devices that the competitors are working on are all going to include strong AI LLM models built in, which will allow for, faster workflow, better efficiency. And I think, Apple need to make a change there. Their strategy, according to Tim Cook, will be aggressive acquisitions. And I hope that holds true for the sake of the company, right? Up until now, they have acquired about 7 companies this year. None were particularly huge, but they have $133 billion of cash on hand, right? Apple can afford almost any company it wants. The one thing I do disagree with Tim Cook, though, is him saying that it's difficult to imagine a world without iPhone in it. Yes, I'm paraphrasing, but while I have been a loyal user of iPhones ever since iPhone 5, I wholeheartedly disagree with this statement, right? I am deep into this ecosystem. I have an Apple Mac, I have an iPhone, I used to have an Apple Watch, which I switched out of, but I do think iPhone can become redundant very, very fast if they severely start to lag counterparts in terms of functionality, especially with the AI revolution. And you already see their products lagging, right? When you look at the ability that some Samsung products have, some of the other Android devices, even Google Pixel now, right? People want enhanced productivity on their phones, tablets, and devices. If iPhone cannot successfully bring that with quality, they are going to lose out, right? I'm sure there was a point in time where people who were working could not imagine a life without Blackberries, right? Maybe even prior to that, could not imagine a life without Nokias. It is important for Apple to stay humble in this race, because look at where those two companies ended up, right? Apple needs to continue to innovate, change with the curve, right? And the regurgitation and recycling of similar features year over year is getting boring, and consumers are going to get sick of it and start looking elsewhere, right? It's happened with me, and I'm damn sure it's going to happen with a bunch of other consumers if they severely start to lag with the AI adoption in their devices. Now, moving on to Amazon, earnings was solid. Light guidance caused the stock to drop over 7% during extended hours, and it's down about 8% for the week. So EPS was higher than expected. Revenue came in higher than expected as well. AWS came in just about slightly higher than expected, but kind of within consensus range, and advertising was higher than expected. So, their second quarter sales grew 13% year over year. This is an acceleration from a year ago when revenue expanded 10%, so solid. And if you look at guidance for the current quarter, Amazon expects operating income to land between 15.5 billion and 20.5 billion. Analysts were looking for 19.48 billion, right, according to Street Account. So you can understand why people reacted negatively, right? They are looking for an acceleration in ROI on AI spend, and the guidance that Amazon gave fell short. Another point that I would say spooked investors was AWS's results, right? They are leading in the space. They are the leading cloud provider, but competitors like Microsoft and Alphabet are closing the gap. Revenue only grew 18%, and this is in contrast to Microsoft's growth of 39%, Azure's growth of 39%, and Google Cloud's growth of 32% respectively. So when asked questions on the call, Andy Jassy did mention that a part of this is due to scale, and he reassured investors that Amazon retains a pretty significant leadership position in the cloud business, so by nature, growth rate would be slower. And, I know maybe some people would think that's a non-answer kind of thing, but to be honest, out of all the big tech companies that reported this week, I'm most intrigued by Amazon. Yes, the cloud business is seemingly growing at a slower rate, right, than that of its competitors. However, their ad business is showing huge signs of strength. It's still a small part, yes, but it's now the third biggest digital ad platform after Meta and Alphabet. The opportunity here in ad spend continues to grow and get larger, right? Especially with AI-driven efficiencies. And another opportunity that I like with Amazon is robotics. Most people are talking about AI and software and LLMs, right? And the efficiency driven by software predominantly. But I think hardware is an aspect that is overlooked amongst this entire AI boom right now. Amazon, in my opinion, are best positioned to leverage robotics. And yes, I say best positioned, not Tesla. I think Amazon are best positioned to leverage robotics. And that bridge between software and hardware in order to increase their margins, increase operational efficiency within their business, right? Another bright spot that I saw was that Jassy mentioned, given any tariff-driven inflation or price increases, Amazon would absorb the costs. This doesn't sound good, right? Because it would affect their margins. But to see that a company is focused on ensuring that customers get the best deal possible, which has been Amazon's moat the entire time. People went to Amazon because they could find the best deals possible, right? This makes for a compelling argument that the business continues to follow its North Star, which is giving consumers products at the best price, right? And the fact that despite these macro headwinds, Amazon are not straying from that core mission is something that I really like about the business, right? Market may have reacted negatively, but this is perhaps where I see the largest opportunity for myself, Amazon as a stock. And I do think if you are true to your North Star, you deliver consumers the best that you can offer, consumers are going to stick by you because you're giving them the best deal, right? And, for those reasons, I actually think Amazon's the company that excites me the most, aside from Google, Alphabet, I should say. But Amazon is one of the companies that excites me the most, on a forward-looking basis. And especially after this earnings season, maybe it's a nice time to just take a bit of an entry. But on that note, that wraps it up for today's episode. It was slightly longer. I would like to remind everyone that anything that I say is not formal investment advice. This is all purely my opinion and is for informational and educational purposes only. With that, I thank you for listening. I'm Anurag Birla, and this is the Finance Now Podcast.